Welcome to the Trad Dads podcast, where we examine cultural and political issues through the lens of traditional thought. All right, thanks for joining me. This is Levi R. I'm going to be talking about the basics of tariffs and other trade policies, and a little bit about the issues with China's specific, with our trade war with China, basically. So to start off, I just want to kind of introduce the basics of trade policy. So if you feel like you already understand this stuff pretty well, then I'm going to put a timestamp in the description, whether it's on YouTube or on the podcast format. And you can just, I'll make it so you can skip to that time code, and then that's when I'll start talking about the specifics of the China trade battle with the U.S. So to start off, to understand tariffs and quotas and all that stuff, first of all, we need to understand trade agreements that might avoid these types of things. So oftentimes countries will be members of quote-unquote free trade agreements that basically put limits on or completely eliminate tariffs and stuff like that for certain products going between those countries. And it could be two countries, could be a whole group of countries. For instance, the famous NAFTA trade agreement, I know Trump renamed it to something else or changed it and renamed it, something like that. And NAFTA is the North American Free Trade Agreement. It includes Canada, the U.S., and Mexico. And essentially what it does is it really reduces tariff barriers between those three countries. Oftentimes you also have what are called bilateral trade agreements, which are trade agreements between two countries. So these two countries might have an agreement, and then those two countries might have different agreements with other countries. So it's not 3 or 4 or more countries altogether. It's just 2 at a time. And then there's also other players in the world stage, like the World Trade Organization, that exerts a lot of influence and kind of acts as an international court for trade disputes between countries. So if, for instance, Brazil had a huge problem with the U.S.'s providing subsidies for cotton farmers in the U.S. And so Brazil made a complaint to the World Trade Organization saying that the U.S.'s support of the cotton industry in the U.S. was unfair to countries with lower technology or lower wealth in their cotton production, because it kind of made it so that the U.S. could cheaply dump a bunch of cotton onto the market and lower the world price of cotton. So the World Trade Organization made a judgment on that, and then the U.S. was kind of I'm not sure if the U.S. was completely forced into it by the WTO, but the U.S. ended up changing its policy with respect to supporting cotton farmers. So those are kind of the basic agreements that we have. And so then tariffs can be, again, part of that, can be limited by those agreements, or can just be, just taxes, really is all they are. They're just taxes that are paid explicitly by an importer. So when you think about trade, you kind of have to, normally we talk about it very simply. We talk about, country A, country B. But really, the way I would think about it is there are four groups at least involved. So you have the producers in one country. Let's call it country A. So the producers in country A, the exporters in country A, the importers in country B, and the consumers in country B. So whenever we're doing some kind of trade policy analysis, we at least need to have those 4 in mind. So a tariff is explicitly paid by the importers in country B. So if country B says, we're going to now levy a 5-cent tariff on every bushel of corn imported into this country from country A. So that means that the importers that take in corn from country A to country B, for every bushel that they import, they have to pay a 5-cent tax. Now, obviously, they want to be compensated for that. In other words, the importer doesn't the incidence of the tax is not necessarily on that importer. They may explicitly pay it, but they're going to try to pass that tax on. So they might charge a little bit more to the consumers in country B to kind of compensate them for that, which would, a higher price that's going to, reduce the quantity demanded of that product in country B, potentially. They might also tell the exporters from country A that they're not willing to pay as much for it, which then would lower the price received for producers in country A, because obviously those exporters would pass that on to the producers in country A. So you can kind of see, and this is always something we do with taxes, is we do tax incidence analysis. Somebody might explicitly pay the tax, but that tax might affect their behavior, and their behavior changes might also affect someone else's economic position. So that's tariffs. Quotas are another tool that are used, that are maybe a little more ham-fisted, but basically quotas are used when you have two countries that don't have an explicit agreement already set up. Or really it's one country with a whole group of countries that they'll allow those countries to export to them. So like the U.S. might have a list of countries that they would allow to export, steel to us. We would import steel from them. But a lot of times we would set a quota on that, and that quota would be for all of those countries together. So let's say, we're only going to import, 10 million tons of steel per year under this quota. And so that means it's kind of first come, first serve. Whoever gets there first to export their quota, those importers in the U.S., whoever gets them first gets them, and then once we get to 10 million tons, then we've met the quota and we won't allow any more. So quota's a little simpler. And then we also have this really confusing one called a tariff rate quota. Basically what it means is that up to a certain quantity, there's a tariff that's relatively low. In other words, a small tax up to a certain point. And then after a certain point, after a certain total amount of product has been imported, then the tax goes really, really high. And so it's kind of meant to sort of soften the quota, a hard quota, a little bit, and say like, well, if you want to pay this really super high tax after a certain point, you can, but you're going to have to pay a much higher tax after we get to a certain point. So oftentimes when we are discussing this type of thing, we get a lot of pushback from people who think that tariffs are just very bad. They don't like tariffs. And what they'll say is they'll say something like, well, tariffs are just a tax that, is paid by the people who are importing stuff, right? So you don't want to put tariffs on China's goods because that just means you have to pay more for stuff from China. And that is probably true in most cases, but that's not the whole picture. So in a book written by Helen called Economics for Helen, I highly recommend you pick this up from IHS Press. I'll put a link to IHS Press website in the description. It's a very good idea to pick this book up. And in the book, Belloc talks about the possibility that a tariff or some kind of trade restriction could actually benefit the people in a certain country. So, of course, you have to have this idea that there can be separate political units and that that's okay. And if you read this short discussion he has, what he basically tells you is that if there are underutilized resources in a country, then some kind of restriction on the other people in that country from buying that resource from somewhere else can be favorable. And he goes through the math, and I don't want to try to walk through it because it's hard to do it without a visual aid. But basically the point is, if you have underutilized resources, then it makes sense to restrict trade to some extent. And so the way I like to think about this is that, when we talk about all of these people in certain areas of the country losing their jobs, this economic decline in these rural areas and stuff like this, obviously that's a tremendous amount of underutilized resources. And so restricting outsourcing, which is it's just international trade in labor. That's all it is. Restricting outsourcing to an extent can be wealth enhancing for the country we're talking about. Now, sure, does it make another country less well off in that narrow sense? Sure. But the idea is that, we're looking at subsidiarity and solidarity here, right? That solidarity is good, but solidarity with those closer to you is more realistic. St. Thomas Aquinas talks about this in the Summa. And from a subsidiarity standpoint, of course, it makes sense that a national political unit would protect the political units that are underneath of it, that provide protection that those smaller political units can't provide. So that's just a kind of a general primer on tariffs. And of course, any resource you can look up just for the basics. There's plenty of good information out there all over the place just to get the basics down. I think where you would start to see disagreements is in whether or not the policies themselves are good or bad. So moving on to the China battle with the U.S. So I'm going to put a link to an interesting little timeline that basically started about 14 months ago that has kind of cataloged every little change in this war, every action by either side. That's really, really good. So I'm going to put a link to that. So ostensibly, this China battle is over the trade imbalance between the U.S. and China. So in other words, we import a lot more stuff from them than they import from us in terms of overall dollar value. And a lot is made about this trade deficit. You get a lot of flack. You get a lot of people having arguments and getting angry about it. So I think that's not necessarily misguided, but it's definitely kind of an incomplete view. And so to try to complete the view, let's just walk through how we might have a trade and what else happens when that trade takes place. So let's say we have, I'm just going to continue to use agricultural stuff because that's what I like to use. Let's say we have, a whole barge full of soybeans that we're going to send from, California to Beijing. And so obviously we have, the farmers in the U.S., we have the exporter in California, we have the importer in Beijing, and we have the consumers in China, which, could be, most directly would probably be hog farmers. That they would feed the soybeans to their hog farmers, and then, people in China would eat the pork. And so what happens there is that, okay, well, we produce soybeans, we put them on a barge, we send them to Beijing. But the other side of that is that now what you have is soybeans in Beijing and Chinese yuan in the U.S., right? That exporter got paid in yuan for the soybeans that they sent to the importer in Beijing. And so what has to happen there? Well, that exporter might trade the Chinese yuan for dollars or something else, right? There might be some foreign exchange transactions that happen with it. But ultimately, for that yuan to have any value, it has to be repatriated in China. And so if that's the case, then that means someone has to spend that money in China. Now, if someone just, let's say our exporter gives that yuan to another person in China another person in California who's an importer from China, and they import blenders or something from China. Well, they might import the blenders and then send that yuan back to China. Now, in this case, if the yuan values are the same, then there is no trade deficit from these two transactions, right? If we sent, a million yuan, and I don't even know what the currency values are here, but let's just say I just need a number for fun. We sent $1 million worth of yuan, or $1 million yuan. Excuse me. Let me say that again. $1 million yuan worth of soybeans to China. So the soybeans went to China. The yuan came here. It changed hands to an importer. That importer said, "Hey, I'm going to buy, $1 million yuan worth of blenders and send that $1 million yuan back to China and get the blenders here in the U.S." So really, there is no trade deficit there, right? There was exactly the same value of imports as there was to the U.S. as there was of exports from the U.S. and vice versa with China. So in that case, there is no trade deficit. But here's how a trade deficit might happen. Let's say our exporter in China decides that he's going to take that Chinese yuan and instead of giving it to someone else who then buys goods from China with it, actually that person is going to take our exporter is going to invest in some Chinese company with the yuan. Well, in that case, we have a trade deficit, right? Because we sent goods to China. So China has a trade deficit now in this case. We sent goods to China, they sent currency back, and then someone in the U.S. invested in a Chinese company. So what that means is we have a capital account surplus, China has a capital account surplus and a trade deficit with the U.S. from that transaction. The U.S. has the opposite. We have a trade surplus and a capital account deficit. So, of course, could these things be negative? Well, sure. I mean, who owns a business matters in terms of the control of that business. You could have, corrupt government officials from China. It's a communist country, for Pete's sake. Could be, corrupt government people buying stock in U.S. companies or whatever. It could also be, people in China or anywhere else, really, buying a lot of U.S. debt and having control over, U.S. bonds. So maybe that's a bad thing. But just strictly in terms of trade, it's not. I don't think it's a really all that big of a deal. But of course, those other things can be a really big deal. So the tariff battle with China so far has been a case of the U.S. imposing higher tariffs on roughly $550 billion worth of Chinese goods. Okay, so let me clarify that. So that doesn't mean that the U.S. is getting $550 billion in tax revenue. What it means is that $550 billion worth of transacted products to the U.S. from China will have higher tariffs on them. Okay, we're going to increase the tariff. And as a retaliation, China has increased tariffs on roughly $185 billion worth of U.S. goods, either imposed or increased. And we're talking about something like 5,000 to 6,000 different categories of goods, both directions. So, the U.S. has imposed these tariffs on about 5,500, I think, last I checked, 5,500 different, individual categories like, soybean meal or, certain grades of steel or just all kinds of different things. You can find the list of products. I probably won't link to it because they're hard to find, but I have seen lists of products before. let's see. And so again, it's the same way with China too. That they've roughly the same number of things they have increased tariffs on as well. So and the timeline probably has some detail in that as well that I'm going to link to. So as far as the trade war itself, has the trade war gotten worse or has it gotten better? Well, it depends on how you're looking at it. So I personally think that a lot of Trump's, reason for getting into this trade war is really just an attempt to kind of improve the U.S.'s negotiating position. So he didn't sign the Trans-Pacific Partnership, which I think is great. I'm so glad he did not sign that. I think if we had Hillary, we certainly would have signed that, and that would have been bad. But it is interesting to look at the way this has panned out so far. So in terms of just talk and meetings and that sort of thing, it's been pretty bad in the sense that both sides are kind of being very standoffish and very adversarial. They keep pushing back meetings and stuff like this. Right now, the latest meeting, Trump refused to hold the meeting and has pushed it back to something like mid-October, I believe. And information is on that little timeline that I'll link to as well. But in terms of concrete actions that either country has made, I think it's been a little bit, I think it's been been a slight de-escalation to an extent. So, recently Trump agreed to postpone some, increases in tariffs on some goods from China. And so, he considered this an act of good faith or something like that. So, that means that certain products that we had been threatening to increase tariffs on, he's at least saying he's going to postpone those increases. So maybe if the tariff was, 5 cents per pound, and we were going to increase it to 10 cents per pound or 7 cents per pound or something. Well, now we're not going to do that quite yet. We're going to push it off and say, well, maybe instead of doing it in October, we're going to do it in December now. So that's sort of what that means. Let's see. China has, I think, done a little bit more. So I think maybe in terms of actions, I think maybe we're in a little bit better position right now than China is. On that timeline I'll link to, there are 2 lists of exemptions with, a few dozen different things that China has said, okay, we're not going to increase tariffs on these other products. And most recently, this was September 13th on that timeline, some of the key agricultural products that the U.S. sends to China, especially things like meat and some of the things that they feed their animals to, they have said that they're going to stop increasing tariffs on those. So I think that potentially, President Xi Jinping has broken a little bit on this, or who knows, maybe it's all some kind of chicanery or something. But I think it is interesting, and I think it's good that Trump is staying pretty firm on this, because again, I think Belloch's argument about underutilized resources makes a ton of sense. And the other thing that an economist normally wouldn't tell you is that there are issues here that are very, very hard to value in a cost-benefit framework. For instance, we all know that China has been massively increasing their influence in other parts of Asia and into Africa, and basically going into these small, poor countries and saying, hey, look, we'll build you all this fancy infrastructure, we just want control. And, of course that's not good for us. Again, China, I shouldn't have to say this again, but, China and the Soviet Union are not different. They're both, disgustingly evil empires. And we should not be on any kind of, cozy, favorable terms with these people. At least the leaders, right? The people in the country are being oppressed and killed. But the as far as the leaders go, I think adversarial is a great way to be with respect to them. So that's really all I have. But I did have some people asking about doing an episode on the China tariff thing. I think I try to give you the basics here, and then also talk about the most recent tariff issues with China, and really, honestly, the 5,000 to 6,000 items thing is, that's the information. If you work in a certain industry, then, the specific amount that of the increase of these tariffs on maybe the products you sell or the products you import and use as inputs in your production process, sure, it's going to affect you a lot more. But this trade war is, I think it's about a lot more than just the trade deficit. So we will see what happens in the future, and if we get a whole lot more, fireworks on this issue, I'll probably do another brief episode just to update. And I do want to apologize for not having an episode last week. Things have been crazy for me, and I think I'm going to try to get back on having a couple of episodes in the tank and being a little bit early with a couple episodes, or having them ahead of time so that I can make sure to get them out on a weekly basis. So I appreciate all of you listening to the podcast. I appreciate your continued support in terms of downloads. Please rate the podcast on iTunes or Stitcher. If you feel so inclined, we do have a donate feature through Anchor, anchor.fm/traddads. And lots of big things coming up here in the next month or so for our little crew. So be on the lookout, and we will be announcing some big stuff here in the next month. So with that, I will say join us next time. Thanks for listening. Thanks for listening to the Trad Dads podcast. If you enjoyed our show, please subscribe on your favorite podcast app and consider giving us a 5-star rating on iTunes. It really helps us out.
The podcast you just heard was made using Anchor. Ever thought about making your own podcast? Anchor makes it really easy for anyone to get started. It's a one-stop shop for recording, hosting, and distributing podcasts. Best of all, it's 100% free. Sign up now at anchor.fm/new. That's anchor.fm/new to get started.